All right, let's get straight to our first panel now. Opinions are mixed on whether a recession is still in the cards, but they're united, basically, on a rate pause today. Here on set with us is Jamie Cox. He's the managing partner at Harris Financial Group. Good to have you with us. Also joining us is Subhadra Rajappa, head of U.S. rate strategy at Societe Generale, and Mark Zandi, Moody's analytics chief economist. Mark, I'm going to begin with you because in this panel, I think you are alone in believing with some degree of certainty that the Fed is likely finished raising interest rates for this cycle. Why are you persuaded that that is the case? And how does banking and a possible banking crisis and a possible concern about breaks in commercial real estate figuring in to that hypothesis that the Fed is done?
Yeah, indeed. I'm confident. You know, I do a lot of forecasting, Tyler, and some things I'm confident in, some not so much. Here, I'm pretty confident that the Fed is done. Lots of reasons. Most importantly, inflation is coming in. It's moving in the right direction. All the trend lines look really good here. You know, obviously, this recent run up in oil prices could be a risk, but, you know, barring that, I think inflation will be back to their target more or less by this time next year. And that does not require any more rate hikes by the Fed. Second, the economy's throttling back. Job growth is slowing. Businesses are cutting back hours. And most importantly, the labor market, which is tight, is easing up. Wage growth is moderating, very consistent with their forecast. And then finally, as you point out, the banking system, it's still very fragile. I mean, it's, you know, it's stable because of all the policy response back in March. But it's shaken. The operating environment for the banking system is very poor, and if the Fed keeps on raising interest rates, I think that would you know, do the banking system and the broader economy unnecessarily so, given that inflation is coming in and the economy is moderating. So everything points to no more rate hikes.
Subhadra, it seems for the markets like a lot of this comes down to that dot plot that Tyler and Steve were just talking about. And specifically right now, there's about 4 quarter-point cuts priced in for next year. A lot of people are saying, you know, if we get fewer cuts, expect bond yields to shoot higher. If it kind of stays where it is, then maybe people keep buying the 10 years like they've been doing since we hit 437 earlier today.
Yeah, that's absolutely how I view it as well. I completely agree with Mark's views on the Fed being done for this cycle. The rates market is really priced to perfection. You're looking at the market pricing in maybe a 50% probability of another hike by the end of the year at the December meeting, and then maybe 3 to 4 cuts for next year. So given the fact that the market's really priced to perfection to the Fed's dot plot, I think any surprise you get on the dot plot, whether it is to perhaps more cuts for next year or less cuts for next year, I think the market's is really positioned to move in either direction. So we'll be really watching the dots closely in the rates market more than anything else. We still think that the Fed is done. I think if they keep policy restrictive and keep it at these current levels, I really don't see the bond market and bond yields rising meaningfully from here. So we'll really be looking towards the dot plot to get a first read on what the Fed is thinking for next year.